All right, welcome to the Explainer. Today we are pulling back the curtain on a company pretty much everyone knows, Target. We're going to get into their financials and really see what the numbers are telling us. So let's kick things off with a bit of a puzzle. Target's stock, its ticker is TGT, it's had this amazing run this year, up over 33%. But, and this is a big but, if you've been holding that stock for the last 5 years, you're actually down more than 26%. So what's the deal? What is the real story here? Let's dig in.
To really get our heads around this, we're going to run through a kind of investor's checklist. We'll kick off with a quick snapshot, then we'll dive into its valuation, check out its profitability, look at growth, and of course, dividends. Then we'll wrap it all up with a final takeaway.
Okay, first up, let's just get a quick snapshot of the company. Where does it stand right now? Right off the bat, you can see we're talking about a massive company. A market cap over $58 billion. And check out that 52-week range. The stock is trading right up near the top of that. That tells you there's been some serious positive momentum lately. All right, so let's move on to valuation. This is where we ask that big, simple question every investor has to ask. Is this stock cheap or expensive right now? Is the price fair? And one of the main tools we use for that is the PE ratio. That's price to earnings. It's actually pretty simple. It just tells you how much investors are willing to pay for every single dollar the company earns. Generally, a lower PE can mean a stock is on the cheaper side. Okay, and this is where it gets pretty interesting. Target's current PE is about 15.9. Now, that's a little higher than its 3-year average, but it's almost exactly in line with its 5-year average. So what does that mean? Well, based on its own history, it's not looking wildly expensive or like a crazy bargain right now. It's just kind of normal. So the price seems about right. But the next big question is, how good is the company at actually making money? Turning those sales into real profit. Let's go check out the engine room. Profitability. Man, this right here really lays out the tough reality of retail. So for every dollar that comes in from sales, Target gets to keep about 28 cents after paying for the stuff they sold. But then you have to factor in everything else, right? Rent, salaries, ads, the whole shebang. And after all that, that profit shrinks all the way down to just under 4 cents. That's a tight margin. Okay, another really important metric we need to look at is return on equity, or ROE. And this one's a big deal. It's basically a report card for management. It tells us how well they're using shareholder money, your money if you're an investor, to actually generate profits. So Target's current ROE is almost 23%. And look, that's a solid number on its own. But context is everything, right? That number is actually down from its 3-year average, which was closer to 27.5%. So that tells us its efficiency at making money for shareholders has slipped a bit recently. And this brings us right back to that puzzle we started with, this conflicting story between recent growth and long-term performance. It really is a tale of two completely different timeframes. Just look at this. The yearly returns have been a complete roller coaster. You got this insane 100% gain back in 2019, followed by 2 really rough years with big losses. And now we're in the middle of this huge comeback. It's been a wild ride. This chart just nails that contradiction perfectly. If you look at just the last 12 months, investors have seen a fantastic 26% return. But zoom out to the 5-year view, and suddenly that average return is negative. We're talking negative 6.4%. That's a huge difference. But performance isn't just about the stock price going up. For a lot of investors, especially long-term ones, the income you get is a massive part of the whole picture. So that brings us to Target's dividend story. And the key number here is 58. 58 straight years. That's how long Target has increased its dividend payout to shareholders, every single year for 58 years. That puts it in a very exclusive club of companies called Dividend Aristocrats, which is basically a seal of approval for reliability. And this dashboard here shows you exactly why that matters. Right now, you're getting a dividend yield of over 3.5%. Pretty solid. The company is only paying out about 56% of its profits to do that, so it's sustainable, there's room to breathe. And here's the kicker. They've been growing that dividend by an average of almost 11% a year for the past 5 years. That's really impressive growth. Okay, so we've looked at the price, how it makes money, that roller coaster performance, and that rock-solid dividend. Let's pull all these threads together and figure out the final takeaway here. It really is like looking at a company with a split personality. In one corner, you have this world-class, super reliable dividend payer that's staged a great comeback and seems reasonably priced. But in the other corner, you've got a business where the long-term returns have been negative, recent growth has actually gone backward, and profitability isn't what it used to be. And that leaves us with the one big question that really gets to the heart of it all for a company like Target. For an investor, does that steady, reliable, long-term dividend, does it outweigh all the recent choppiness and the struggles with growth? Honestly, there's no single right answer here. It all comes down to what kind of investor you are and what you're really looking for.